let's look at some of the tax advantages of these oil and gas investments. And I'm throwing this number up here on the screen. Not sure if anybody has a clue what this number is, but I'll just leave it up here for a second and to see what you guys think this number represents. Okay, I'm going to move on here, and of course, we'll get back to that. So think it through. But really, when we're talking about oil and gas, and I'm looking at this from the perspective of an investor, okay, I'm not looking at it from somebody who's, sitting on 100,000 acres in Texas and has some sort of minerals, oil, gas, whatever it happens to be, and we're trying to figure out, what's our best strategy. That's not who I am. I haven't been representing those kind of clients ever really. But as far as investing in those types of projects, absolutely. And that's what we're going to look at tonight is these three terms that are in this grayish color here. These are the three things that you need to know about oil and gas investment. The other three that aren't highlighted, the depreciation, the tax credits, and the active versus passive, we see that in a lot of other types of businesses, real estate, whatever. But these tangible drilling costs, these intangible drilling costs, and these depletion deductions. So these three are the big three when it comes to oil and gas. And so if you're a new investor, you're going to take a look at some project, let's say, or perhaps you've already got some investments in oil and gas that are returning hopefully some income for you. They're also kicking off some tax deductions as well. So again, those are the three that I really want to focus on here tonight. When we look at the oil and gas investments, though, same corporate tax rate as any other business. So if they're set up as a C corp, or if you're set up as a C corp to receive this income, same rate, this 21% rate applies. So no difference there. The difference, though, is that the tax code figures that, look, eventually, whatever it is you're mining, so if we're talking about oil, eventually, no matter how good the well is, it's going to get used up. Right. Eventually, we're going to get down to the bottom. And so the tax code recognizes that our resources are going to get used up. And there's a lot of financial risk involved with drilling. So there's a lot of upfront costs, and there may be no benefit on the back end, right? It's possible that you could drill with very little or no revenue coming out of the hole that you just drilled. So the code recognizes some of these different variables and some of these realities of the risk with this type of investment over, let's say, an investment in the stock market, let's say, or a bond, or maybe buying a rental property. So these investments are different as far as the risk involved, certainly with whoever's doing the project, and then anybody that's putting in money to invest with that producer is taking some of these risks as well. So what are we looking at here as far as our tangible drilling costs? So this is one of our big three with depletion and intangible drilling costs. But when we look at our tangible drilling costs, we're really looking at a lot of equipment. So what equipment is really going into this production? And so that's our physical equipment to create the oil well, anything above the surface, any casings, any drill bits, anything that you're going to be using to try to extract the oil, the gas, the mineral, whatever it is that, whatever natural resource that we're talking about. Now, you'll see down here at the highlighted part, as far as the business goes here, 100% tax deductible. Okay. So that means that if this number happens to be 10 grand, the business can deduct it all. And so we don't have to worry about any sort of expenses where we're not going to get the tax deduction. It's going to be a question of when do we get it? And so here we can certainly depreciate all of this over 7 years. So our worst case scenario is it's going to take us 7 years after the construction begins to be able to recoup all of these tangible drilling costs. So if we look at something where, we've got 10,000 or $100,000 of investment, 15% in the tangible drilling costs. So we know there that $15,000 of the investment is going to be depreciated over this 7-year period. So it makes it a real nice position here because for somebody that makes this investment, you can see that we're going to get some tax savings here based on the depreciation. And so that's something that is going to certainly play out pretty well. And if we want to really push it, which certainly we would be looking to do, I would think most of the time, we could take 100% of that under bonus depreciation or Section 179. And so somebody in this tax bracket, instead of just deducting a few hundred, is now going to be able to deduct, 5 grand, in this case, 35% of what the deduction happened to be. So we get all of these tax deductions no matter what. So if we go in and, let's say we put this $100,000 investment in and we start doing some drilling. So we have these tangible drilling costs, and then we hit nothing. So we've got a dry hole here, no revenue coming out of it. So what do we do at that point? Well, basically, we still get to deduct all of our costs. We get to deduct all of our expenses. And so even though the well didn't produce anything, let's say that my $100,000 investment was a total loss. Okay, that they drilled and nothing, and I lost everything there. I can deduct this entire investment in year one. So we're not subject to the capital loss limitations. So if I put $100,000 into, the next great company and it turns out to be Enron and it goes bankrupt, these capital loss limitations apply. And so I could only deduct 3 grand of that 100,000 every year. So it's going to take me potentially 33 years before I can use it up. Not so in an oil and gas investment. So when we're looking at that's all of our tangible costs. And again, whether we strike oil or we hit nothing but dirt, either way, we've incurred these costs. And we've also incurred a lot of these intangible costs. And this is another part of it that is huge, in the sense of this is everything that goes into creating the well except for the actual equipment. So it's something to the effect of, let me move up one more slide here, where we're talking about the IDCs, we're talking about not the equipment. So I'm not talking about these wells or the drill heads or whatever, but I'm talking about the labor. I'm talking about the freight, the leases. Maybe I have to lease some land, or maybe I have to lease some equipment, any of the rig time that maybe I'm paying for by the hour or by the day, any costs of expenses, of fluids, of any sort of expenses that are incurred to keep the equipment running. All of those can play into the IDCs. And we say, well, so what? Who cares about the IDCs? Well, if you don't invest in oil and gas, you don't really care. But if you invest in it, look what happens here. Typically, we're talking around 3/4. So somewhere between 70 and 85% of the well costs are going to be these IDCs. Now, this makes it huge in the sense that look what we can end up with here. 70 to 85% of our investment can be deducted under this code section 461. And so in the first year, if I put up that $100,000, I may be able to write off 70 to 85,000 of that in the first year. And so that really, really changes my whole investment strategy, right? And so if we're in these independent producers, I mean, sometimes we can see it where if it's a real small producer, it can go up to 100%. And the big companies, that are producing, hundreds of thousands or millions of barrels of oil, they're going to have that number limited to 70%. But if you think about 3/4 as sort of our sweet spot, that's what we're going to get as an investment. And so even though it varies from project to project, and they'll tell you this up front as far as what it is, But if we look at this guy here and we say, all right, we get this 85% hit here the first year. Well, okay, what does that mean? That means that when I put my 100,000 in, I get to deduct $85,000 from my other income. And so I put this his, her, or its because it could be an entity that is receiving this. So it don't necessarily be a person here. But the bottom line is that the government is really picking up a lot of the risk here. So given the significant tax benefits here, with the upfront deduction, it reduces the overall investment risk. And so basically whatever your tax bracket is going to be what your savings are going to be. And if you've got a state income tax, like people like me in Colorado here, same thing. I'm going to get that at the state level too. So these intangible drilling costs are massive as far as the tax benefits go. Because again, I can throw $100,000 in to this investment, get 85,000 of it back as far as a tax deduction goes. And so I really only have the $15,000 at risk here. And lots of permutations on what could happen with this. But I just want you to think about the overall upfront component of what these particular investments will permit. So I've got to throw in my usual Homer Simpson here, keeping at least a couple of the tax cartoons kind of light as far as the oil and gas goes. But let's move on to the depletion part. And this is the third component between the intangible and the tangible drilling costs as our 1-2 punch. Our third one is depletion. And, I like to think of depletion as being very similar to depreciation. And so what we're doing here is the tax code is allowing investors to shelter some of the income that you're receiving from an oil and gas investment based on the fact that the oil well is being depleted. So in this case, it's, whatever the reserves are, if we knew that to the exact amount, whatever we're pumping out of there is reducing those reserves. And so when we're looking at depletion, we're really looking at two different things. We're looking at this cost depletion and we're looking at statutory, or this percentage depletion. Now, again, you may say, oh man, this is getting sort of kind of nitpicky as far as the accounting terms go, but these are really important as far as what the overall investment can produce from a tax perspective. And so, again, oil and gas, it's finite. So it's not endless. I mean, you may have big reserves, but you're eventually going to use it up. Just like with depreciation, when you go out and you buy a new car, you buy a new computer, eventually it's not going to work anymore. And whether that's a few years or a few decades, maybe the oil and gas well will go on for 50 years. Maybe it won't. But we know that at some point, the resources are going to get exhausted. So again, with depletion, we have two different uh, portions or two different ways that we calculate this. The first one is cost, and this is what the real big guys have to use. It's fine as far as the cost depletion goes, but it will eventually stop. So once the investment is recovered, then the cost depletion stops. Whereas with the percentage depletion, so this is 15%, this continues for as long as the well produces income. And so I can't emphasize this enough that a lot of times this is what is going to make a huge difference in the particular investment because maybe in year one you've used up your whole investment, right? And as far as the tax deductions go. And so maybe 5 years from now, this well is really producing. You've got a lot of income coming in. Finally, right? As far as the income is now coming in based upon what you were hoping for as far as the investment goes, now the depletion can continue and you can shelter 15% of that gross income from taxes with using depletion. So we really like this percentage depletion allowance. Now, a couple different components of this. We can't produce a loss with it. So once we get to 100% of the taxable income of the well, that's where the depletion stops. And when you look at all of the properties or wells that you may have or the entity may have, it can't exceed more than 65% of your overall taxable income, which I would be surprised if it did. That's a lot when you consider that the maximum we can take here is 15%. And so I haven't seen this instance. I'm not saying that it doesn't exist or that you may not, you may be on this webinar or watching this in the future and go, well, hey, that's me, I exceed this, and so therefore I'm limited in what I can do. But this is I would consider it to be a very rare provision that would kick in. So again, $100,000 investment, we get this 15% depletion deduction. So the net effect of that is really for every buck of income we make, we're only going to get taxed on 85 cents. And so it gives us the shelter that permits us, and this is the code section, this IRC section 613, but this code section permits us to basically shelter some of this income. So this is a legal way that we can avoid taxes on income that from other investments, if this was rental property, let's say, I'm going to pay tax on the full dollar of income. Less any expenses, of course, but there's no such thing as this depletion deduction that I'm getting here in example 3. Depreciation, did mention that that does apply here. We're looking at the 7-year period. I mention this only because in the future, this is going to apply again as far as the depreciation periods go. But now with the bonus depreciation, we're really getting that full upfront deduction in year 1. But depreciation not any different than this computer that I'm doing this webinar on, or a car or whatever. Same exact, using something in business, expecting to last longer than a year, and eventually is going to get worn out. So these are all very, common type things, whatever you see above ground, any surface equipment or pumping or casing, tubing, wellhead, storage tanks, any of this stuff that is a big capital expense, but it's going to last, or certainly we hope it lasts more than 1 year. We can then go ahead and depreciate that. And again, I mentioned bonus depreciation applies. So we can, in effect, with our intangible drilling costs, we can really combine this IDC thing with the depletion, with this bonus depreciation, and putting all that together may mean that we get 100% deduction of whatever our investment was in year 1. And we're going to gain some benefits in year 2 and beyond. So again, these are very tax favored investments. And I think, part of it is the risk involved. That if you're going to take this risk, and there's a chance you're going to throw this $100,000 in and get nothing back. And so if you do get something back, it's going to be very tax favored. And when you put the money in, whether you get something back or not, you're going to get this big, big year 1 upfront deduction. Okay, tax credits, not a lot of help today, but in the past, it's been huge. I always encourage people to look at the credits that are available. So here we've got a small producer tax credit, and then also when we're using different methods of recovering oil or whatever from existing wells, whatever that may be, CO2 injection or what have you. All of these things then qualify for credits. And you'll see when we really need to encourage oil and gas production, that these credits can get to be a lot bigger too, and a lot more numerous. And I just mentioned these two It's just simply because I want you to be aware that credits can play in the future, just like in a lot of other businesses, right? Where, certainly in real estate or whatever, we're always looking at, well, what kind of credit can I get? Or is there a credit that I can get? And the same thing with businesses. And so with oil and gas investment, if we can pull a credit on top of these tax deductions, man, we can really, really come out on top. All right. A couple of other concepts, and sorry for these lines on here. These were some of the things I drew, and for whatever reason, my eraser isn't working. So, um, anyways, that's, I guess, adds some modern abstract art to our slides here, but they should go away if I knew what I was doing, I suppose. But anyways, working interest versus royalty interest. This is really big distinction. And the reason it's a big distinction is because what I've been talking about up to this point with these IDCs and tangible drilling costs and everything is a working interest where we have an interest in this investment, and in theory, we could lose it all. And so that's considered to be a working interest. And you'll see why that's important in a minute, because we're going to talk about the royalty interest. So this is something where I may invest in a particular in whatever production here, and in return for my investment, I get a percentage of the gross production. So let's say that I'm looking at an 18% royalty. So that's what I want. So I put in whatever it is, my 100 grand or whatever, and I'm going to collect 18% of the revenue. And not of my 18,000, or excuse me, of my 100,000, but whatever of the revenue is. So if the revenue happens to be, let's say it's $1 million, my royalty here could be $180,000. But if it loses money, 18% of nothing still comes out to nothing. The one big difference, though, is that I'm never at risk for the losses or the expenses. Okay. And so I'm just getting my 18% royalty here. The working interest is the one that is active in the business. So this is not something where I'm getting this guaranteed 18% royalty. I get money here after everybody gets paid, including the royalty interest. So after the royalty gets paid and all the other expenses get paid, then I get paid. And that's where, with our working interest, we can deduct any of those losses, right? The expenses for the IDCs or the tangible drilling costs or whatever. You can offset that against any other income. So maybe you got stock trading, maybe you've got some business income. Maybe it's somebody like myself who has income from a law practice or from royalties from book sales or salaries, wages from a W-2 job I may have. All of those losses or expenses can be deducted against this with my working interest. So when you see this active versus passive sort of analysis, when we're talking about a passive activity, what we're really talking about is the royalty interest. And at that point, we have to worry about passive activity losses because you can't offset these losses against other active income. So it would have to be against other passive businesses. Now, from a royalty perspective, you're not going to typically have a loss, so it's not going to really matter. But just understand that we're talking about passive income, whereas the working interest investors is basically looking at ordinary income here. And it makes a big difference. So let's just take a quick look at a very fast $50,000 example. So I put $50,000 in to this project, and the developer is telling me that 85% of the upfront costs are IDCs. Okay, no problem. So I know then that I've got a balance of 7,500 left after I take this big deduction up here, right? And so depending on what my tax bracket is, if I'm in the maximum tax bracket, I'm going to be able to save almost $16,000 in tax with this IDC tax deduction. Okay, so that becomes a really, really favorable tax plan right there. And you're saying, well, what about the 7,500 that's left over? Well, we can bonus depreciate that. And so again, if I happen to be in the very highest tax bracket, the 7,500 bucks is going to save me almost $3,000. And combined, my investment here of 50,000 is producing 18,500 of tax benefits, okay, or 37% of my $50,000 investment. So really big upfront tax benefits that are at issue here. Uh, and so here's a way I think we take a look at it as far as, do you want to be in the working interest, which is going to get you in my opinion, the best tax deductions, because the focus here is those early upfront deductions and ongoing expenses as the well goes into the future. Whereas the royalty interest is going to get depletion, but that's it. And so they're going to hopefully get a steady reporting if the well is producing like they're hoping. So we share some of these operating costs where the royalty guys don't have to worry about that. This is passive. This is typically active. And typically you're going to get a K1 because most of these oil and gas companies are set up as LLCs, LPs, or S Corps. Some are C corps, but most of the time you're going to get a K1. And for the royalty guys, you're going to get a Form 1099, just like you'd get for interest or mortgage interest that you paid, or certainly the interest that you received from a bank or what have you. So comparison between the two. Now, the question I get then is, what happens if or when I sell my investment? Well, when you make that $100,000 investment and you reduce everything to zero, your basis is also reduced to zero as well. So when we take that 85% deduction for the intangible drilling costs, my basis goes down by 85% as well. And then the years as you go along, where if we've got these passive activities in there, sometimes we're going to have pluses and minuses as far as what the K1s show. But in general here, um, you're going to have a very low basis compared to what your original investment was. And you have to think about, how does this investment end? Certainly you could sell it, in which case you're going to have some gains to deal with, and I'll show that to you in the next slide. Or if you just invested until the well basically goes dry, you don't have to worry about it. There's no value at the end of the investment. But here's some of the ways that we can look at this particular investment here. So if you happen to sell it and it's sold at a gain, then whatever the intangible drilling costs were that you deducted before get pulled back in as income. Okay, and it's ordinary income. It's not a capital gain. Anything that's over and above the amount that you recapture. So say you have 50,000 of IDCs, but you sold it for $100,000 profit. The other 50,000 of profit there would be a capital gain. So we do have long-term gains here, and we do have recapture amounts. Now, you still want to do this. And here's the reason why. Let's say in year one, you have 100,000 investment, and I'm going to give you a $100,000 tax deduction. And then in year 10, you've got to report that $100,000 tax deduction as income. You are going to get 10 years worth of benefit of that $100,000. So even if you just put that into some money market that was just paying a few percent, over 10 years, you're going to have more than $100,000. So when you have to pay the tax back on that, you're still going to come out ahead. So just look at the time value of money, because that's what's really going to give us a lot of the bang for the buck here. So tax avoidance, deferral strategies. I just mentioned the long-term capital gains here, the fourth bullet point. But the one that I had highlighted before I got to this slide, actually when I was doing it a little bit earlier today when I was filling in some of this, um, The first one, you have to maximize the expenses, the depreciation, the depletion, the intangible drilling costs. And then the last one, which we haven't talked about yet, but I will soon here, is the Section 199A. Remember that we can do 1031 exchanges in some instances. We can use charitable planning. So estate planning strategies can come in with gifting or charitable, or let's say to our kids. And we can do these investments in an IRA. Or a retirement plan of some sort, Roth or traditional. So 401k, anything where you can self-direct it, you can do these types of investments. So you have a lot of possibilities from a tax perspective as long as you heed the yellow portion that I have up there with the expenses and the 199A. Now, Kendall mentioned at the beginning about it's possible to do these oil and gas investments and be able to reap some benefits as a 1031 exchange. I don't want to go into the 1031 exchanges because actually, I think Don and I several years ago did an entire webinar on 1031 exchanges, and Aaron Adams, I think, has done them as well. So there's lots of information on the Protect Wealth site that you can get on what a 1031 exchange is. But basically, it's a way to defer your taxes on a capital gain. And the question then becomes, well, what if I have a capital gain with mineral rights? Can I do it? And the answer, like pretty much everything else with taxes, is it depends. It depends on state law. So, does state law say that mineral interests are real property, or does it say that they're personal property? And so, if it classifies them as real property, then the answer is yes, they qualify for 1031 exchanges. So, the state level classification plays a major role. And you could expect certain states to be very favorable here because they have a lot of mineral rights, a lot of drilling, a lot of oil and gas. So Texas, Oklahoma, my state of Colorado, Kansas, Wyoming, a whole bunch of the states that you might think would have some of these real benefits are ones that really do. So the first thing you need to find out is what state are you in, and how does that state classify the mineral rights? If it classifies as real property, you're in luck as a potential 1031 exchange. If it's personal property, like a car or a computer or something, no such luck. So when we're talking about the 1031 exchanges and these rights under state law, we're really talking about these three guys in general. The hydrocarbons, that's what I've been focusing on tonight, really, the oil and gas. Metallic minerals, so those are gold and silver, and then the non-metallic minerals, coal, gypsum, limestone, whatever. And so any one of these three different categories can certainly apply as far as the 1031 exchanges go. And I put this up here because you can see where a lot of the oil and gas is centered here in the United States. Obviously, real big here in Texas, but even in Kendall's state and my state here in Colorado and Utah, quite a big basins as well. So these are states that are typically favorable to the property rights. But again, before you go making any sales or trying to do a 1031 exchange, make sure that you qualify for it. So, working interest versus royalty interest. Working interest may qualify if it's a real property interest. Okay, so as far as that goes, we need the two things. One, working interest, and two, state says this is a real property interest. But if it's constructed as a leasehold or if it's a royalty interest, not going to qualify. And so any of these sort of royalty interests, don't think about a 1031 exchange on the back end. If there's a capital gain, you're going to have to pay the tax. There's no way to avoid it with a royalty interest, at least under current tax law. So I think if we look at these as far as some of the benefits go, then in year one, obviously, we have this huge benefit where we can go up to 100% of our investment. So obviously, very, very favorable investment there. But I think year two becomes really important as well because we've got this potential Section 199A, and this gives us another 20% deduction. And I'm going to let me get back to that in a second. And then the third bullet point I've already mentioned, this depletion guy gives us 15%. So even after we've zeroed out our investment, right up here, we've already taken 100% of it. In year two, we still get this 15% deduction. And bullet point two becomes critical because how you structure yourself and your personal entity structure is going to determine how a lot of this is going to be taxed. Now, I mentioned before that a lot of the producers are set up as limited partnerships or some sort of a joint venture, some sort of where we're going to get maybe some sort of LLC, limited liability protection, but they're going to kick off a K1. They're also going to kick off investment income or business income, I guess, in this particular case, to you. And most of the time, we're going to want to hold our particular investment in an entity. Typically, that's going to be a flow through entity. So let's say I set up Scott's LLC and take this income here. Now I qualify for this Section 199A deduction. That's the QBI. And again, I've done webinars on this. This will be discussed in the 2-day class that Kendall was talking about at the beginning. Guarantee it because this is massive. Qualified business income does apply in a lot of the instances with these investments. So not only do we get this 15% guy down here, potentially we could throw in another 20% here. So when I'm looking at the final considerations here, as far as what is it that I want to be looking at as an investor from a tax perspective, number one, flexible. Okay, be flexible here. And I don't mean only with investments, but obviously if you're investing in anything, whatever it happens to be, if you invest with Mike Koval and he does a lot of the stock trading and the option trading and whatever, you still have to have flexibility there, right? The stock market doesn't always go up or it doesn't always go down. There's a lot of weird things that can happen. And so we need to maintain flexibility. The same thing goes with tax planning, right? Tax laws change. When if I was doing this webinar 6 years ago, back during COVID, who knows what all the tax laws are because they were changing, it seemed like, every hour. So we need to have flexibility with our tax plan. Understand too that this AMT guy, this alternative minimum tax, may apply here. So it's possible that some of the tax deductions that you get may come back in under AMT. And so this is where your personal tax planning becomes huge. Okay, I can't emphasize that enough that, there's no way tonight. I have no idea for the thousands of people that are going to be watching this webinar, either live or in the future. I have no idea what your personal situation is. I have no idea what kind of entities you have, where your income is coming from, what your age is. Are you married? Do you have kids? What are your expenses like? Do you have self-employed income? Is it investment income? Is it retirement income? So there are so many variables and so many permutations here that you need to be aware of. This is the way I'm structuring myself to be able to receive the investment income. And of course, to do that, you need to know, well, how is the entity structured as far as where this income is coming from? So where's the money coming from? What's that structure? And what structure is it going to hit when it comes to me and my tax return? This is, I think the due diligence is critical because of the risk. And I don't say, well, don't do due diligence for, a rental property or don't do due diligence for, deciding if now's a good time to buy Google stock. Well, obviously you need to do due diligence no matter what your investment is. But here I think you've got some special sort of due diligence. Who's the operator? Similar to a stock where, you have a company like Johnson and Johnson that's been in business for 100 years, or is this a business that is brand new and has been in business less than a year? So what has the operator done in the past? What kind of track record do they have? What do the engineering evaluations look like? What are the geological reports? What kind of economic projections are there here as far as, we're banking on so many barrels of oil or so many cubic feet of gas or whatever it happens to be? What are the projections? What's the risk analysis? What's the likelihood that this is going to hit versus not? Legal structure for the producer and yourself. And the only one I haven't highlighted is one that I've seen throughout the last 30 years or so of practicing tax law, and that is, do not make these investments for the tax benefits. Again, I've seen it where we get 100% bonus depreciation and people are thinking, oh, it's free and I can't lose. It's like, yes, you can. You can lose. So don't invest for the tax benefits. Now, if you're looking at an investment, you're saying, yeah, this one looks like a pretty good investment. Now the tax benefits could make this a killer investment, right? Just a great deal. They may have taken an outstanding investment and just, made it super, super incredible. So due diligence is required. Do not skimp on any of these 6 bullet points. You need to take care of yourself and make sure that, whatever you're investing in, you've got the best opportunity to succeed. The tax laws then will be in place to help mitigate some of the tax harm, I guess, right? Having to pay a lot of tax on your investment income. But if we look at the final potential scenario here, so we have a couple of married couple, highest tax bracket, so 37% feds, 5% for state, and they invest 200K in this oil and gas project. They find out that the IDCs are 70%, so they know on their 2026 return that gets filed sometime in 2027, they get this 70% tax deduction. And they also are going to get a deduction for these tangible drilling costs. And so, in effect, they have written off this $200,000 against, let's say, the husband's wages or the wife's wages or whatever it happens to be. And so, what have they done here? Well, they've in effect saved themselves 42% in tax, right? We've got 37% up here. We've got another 5% down here. And so the first year tax savings on this investment is $84,000. Now, when they go for the next year, so now we're done with 2026 and we go into 2027, let's say that we now have income from this project. Well, if we're getting this qualified business income, we can deduct 20% of that. So that's our Section 199A. And if we're going to get this depletion deduction for the life of the well, okay, not until the investment is used up, but for the life of the well. So if this guy goes on for 50 years, we're going to get this 15% deduction for 50 years. So again, next year, when we look out, we're still getting tax benefits out of all of this. Now, a couple things I want you to avoid as far as some of the common errors. Don't mix when you're doing active working interests with these passive royalty income. Okay, so if you're going to do that, structure it in two different entities or take them in two different ways. Don't do it through the same business. Not having the correct structure for yourself is a major problem because you need to know how this income is going to be received and how the expenses are going to be incurred. Again, depending on whether you're a royalty guy or whether you're a working interest guy. So this could be a Schedule C type event, Schedule E. It could be, on both of those on the 1040, or it could be a subchapter S, could be a partnership or an LLC. You could have it set up as a C corp, I guess, if you really want to. So lots of different possibilities. Another mistake I see, claiming depletion, not depreciation, claiming depletion without the right income and information. So make sure that your accountant knows what they're doing and you get them the right information on the depletion and the depreciation if you have to deal with that for any of the tangible equipment. Failing to track the basis, so not knowing what your basis is, then selling it and having a gain that you're either paying too much or too little in tax. And then the final one is that find out when the K1s are going to arrive. So a lot of these entities, oil and gas entities, file extensions. I get my K1s in June or July. And so if I've already filed my 1040, guess what? I've got to amend my 1040. And that gives the IRS another opportunity to look at the return and audit it. So if you know you're going to get these guys late, meaning sometime after April 15th, file an extension and go ahead and then file your original 1040 after the Schedule K1s arrive. So those are the common errors. I'm going to leave you with this little chart here, trying to keep myself in the 1 hour time frame. And for whatever reason, tonight I've done a good job. I'll pat myself in the back. I'm at 55 minutes here. But I want you to just consider this because what we've seen here in the last, let's say 3 or 4 months is that oil has gone up considerably. But historically, there's always these events that happen. I mean, and this chart takes us all the way back 100 years or more than 100, 150 years to the U.S. Civil War. So you'll see a lot of times the prices will spike when there are wars and what have you. But notice that the price of oil does not always go up. And so you need to be aware that when you're making these investments, that you may be investing in this well when oil is $110 a barrel, and when it starts producing is now down to $50 a barrel, right? So we could have one of these situations where we're right here, and then you make the investment, and what does oil do? But it goes straight down. So that is a possibility. And what would happen if the price of oil per barrel gets dropped in half? What happens if it doubles where you invest right here? You put your money in right here, and yeah, it goes down a little bit, but then all of a sudden it just starts spiking outwards. So be aware that this is a very volatile investment, goes up and down quite a bit. So you can see kind of here, right? It's doing this sort of a thing, and I would expect that to continue. And what's going to be the best way for you to be able to handle that particular investment? So, two things. One, I always will end my presentations usually with this slide because I really hate to hear people talk about how the tax code is unfair. Of course, it's unfair. It's unfair to all of us. We all think that we're overpaying taxes, so don't expect fairness here. But do understand the laws and do understand that if you're making an oil and gas investment, you need to be aware that we've got some very specific tax provisions, most of them very favorable to us, and you need to take advantage of them. And the final thing I'm going to leave you with is that number, that 1.5 trillion number that I had up there. Of course, when I'm doing these presentations, I go down rabbit holes, and I wanted to find out how many barrels of oil have been pumped out of the ground so far. And when you really go back, you're going really back to about 150 years, and the estimate is 1.5 trillion. So there you go. If you're ever in a trivia contest or whatever, and you need that answer, you now have it. But I'm going to leave you with the unfairness sort of slide that's up here. Turn it back over to Kendall for a few closing comments, and certainly want to thank everybody for this hour of time that you've spent here. And hopefully it's been somewhat informative as to some things that you need to be looking at if you want to do one of these investments. So thank you.
Thank you, Scott. Very, very informative. Absolutely incredible. I think for me, for sure, it was eye-opening, all the different nuances to the tax strategy. It makes it, I already have heard over and over, it's marketed out there consistently as a very good tax strategy. But like you said, it can take a good tax strategy to a great tax strategy for a lot of our investors out there. So love it. Thank you so much for sharing today, Scott.
Absolutely. Thank you for having me, Kendall.
We appreciate it. And guys, I'd recommend, I want to put a link here in the chat. At our upcoming summit, we do cover a lot of these different strategies. So I definitely would love to have you attend a summit. We have experts like Scott and different attorneys and advisors on throughout the event that can answer a lot of your specific tax and legal questions. And Scott, I know we don't have a lot of time for questions. Maybe just one or two here. I've got Hadaley asks, can this be done through an LLC or just as a personal investment?
It should be done actually through an LLC, I think. I mean, I just think that anytime you're dealing with oil and gas, you have risk. And granted, when you're investing in it as, just an investor and you're not actually, drilling the well, your risk is going to be pretty small, but you need to consider how you take the income. And I think that's a really good question that I'd be looking at probably an LLC, and then how you want to structure that for taxes is going to be up to you. You could make that an S corp or a partnership or disregarded entity, C corp. You've got a lot of different options for how you tax that LLC.
Yeah, you're right. And so if you have something goes wrong with the investment, it's nice to have the LLC give you a little bit of protection. And if you're looking at other options for funding, maybe a self-directed IRA or something of like that nature, right, Scott?
Absolutely. Yeah, there's no reason why you can't do this in an IRA. And think about if this is something where, you do it in a Roth IRA, and let's say you hit a home run on it, right? Where it's producing a lot more oil than what you were expecting. All that future oil revenue that's going to come in as a result of this home run investment is all going to be tax free. Right. And if you do it in a traditional IRA, it's still going to be great because you're going to get the tax deferral. At some point, you may have to pay taxes on it, but we're still going to be able to defer it. So, good point. Yeah, for sure. Do it in a retirement plan if that's something that you have available to you.
And that just brings up another comment. Tax planning is really all we're talking about here, guys. This is kind of it. And Scott, you're so good about this. It really is a tax game, and you need to play it because we're stacking strategies here.
Yeah, yeah, we are. And again, our job, I think, like as investors, like when I'm looking at a stock to buy, I've got to make sure, okay, am I buying Microsoft at the right time? And, if I'm going to do an oil and gas investment, is this a good producer? Do they have a good track record? What are the engineering reports? Oh, it's pretty favorable. So everything is looking good from my investment standpoint. Now I can say, what are my tax benefits? Rather than going, oh, I can get this 100% deduction, and then I go ahead and invest in a dry well. And it's like, well, what benefit have I gotten by doing that? Right. So we still want to make sure that our investment is solid. Then we go for the home run with the tax benefits.
I love it. Yeah. Go for the good investment, then tax benefits and stack them. I love it. Okay. Chad asks, can tax benefits be applied to previous tax bills, previous tax years bills?
No, they can't. I mean, you can't have a loss this year and carry it backwards. If you miss some expenses, let's say you had one of these investments, in 2024, you can go back and amend the return then and claim the missed IDCs or other expenses, but can't go retroactive on the carrybacks as of today. And that's one thing that changes all the time. So that's a great question. And if you ask that question in a year from today, the answer could be, oh yeah, that's a brand new tax law. We can carry it back. Or it could be what it is, what I just told you, and that is under the law today, we don't have that carryback provision.
Yeah. And then we had two questions here. I think we can wrap it up with these two. Tim and Bishma were asking about if you put it into a self-directed retirement account, don't you lose tax benefits that way too? Well, yes and no, I guess. It depends how you look at it, right, Scott?
Yeah, absolutely. You would lose the tax benefits in the sense that you wouldn't get that IDC deduction on a tax return, right? And so, yeah, so you definitely want to look at, am I better off to do this particular investment in a taxable account versus a tax deferred account? And it's a similar type of investment analysis that I do with real estate in a taxable account versus a tax deferred or tax-free account. It's the same thing. You say, well, if I do it in a taxable account, I'm getting the depreciation and other expenses that I'm not going to get if I do it in a retirement account. And it's like, that's exactly right. So you need to look at what are the benefits of doing it in a taxable account and getting these tax deductions versus throwing it into a retirement plan and losing some of those tax benefits, but gaining other tax benefits, meaning tax deferral or tax-free income, depending on the type of retirement plan, right? Roth versus traditional. So those are excellent questions. And I could probably take, if we were doing this live, like in a Las Vegas ballroom or something, I could take 10 people in the audience and we could come up with 10 totally different scenarios of how they should structure this retirement plan, no retirement plan, some retirement plan, do it all in a taxable account. They would all be different based upon the fact that we're all different and we're at different stages of our lives. So the big thing is don't do a one size fits all. Do your due diligence. And then once you decide it's a good investment, make sure you've got the right structure so that when the investment hopefully plays out in the future, right, and pays off, that you've got the structure in place to best maximize the tax deductions and the income.
I love it. Yeah, thank you so much. That's a great way to end the webinar tonight. And guys, that's exactly why we recommend you come to the Asset Protection Summit. It's there in the chat screen. Click on that link to register. That's exactly why we do it, because there is not a one size fits all. And sometimes Scott and I have talked about this over and over the years, and I love it. It's true. Like a lot of times, yeah, I want a self-directed IRA for my investments. Absolutely. Paying no tax is the ultimate. But sometimes if I know I have other income and I can offset it, sometimes it makes sense to have different entities personally all over the place, and that just is very individual. Nothing specific, right, Scott?
It's exactly right. So you just have to look at it as this is a snapshot of who I am at this point in my life. And my entity structure and planning looks a lot different than it did 20 years ago, right? And yours did too, and yours
Yeah.
will look different 20 years from today. So we've got to be flexible with life and with the different changes that we have. Couple that with the investment changes and the tax changes, right? The legal changes, and you put all that together, and yeah, we have to be flexible, but definitely not a one size fits all. And I think that's where the summits come in, that you can really start to tailor it over those couple days to something that fits you, not to, the thousand other people that are watching the event, but specifically to you. That's the real big advantage, in my opinion.
I appreciate it, Scott. And thank you for sharing your expertise tonight. It was very eye-opening for me. I didn't know there was that many different strategies. I'll definitely have to be looking at my investments, and it's true. Maybe an LLC, maybe me personally, and maybe an IRA. So I love this because, yeah, there's a lot of different options at least, and you have to play the tax game. And truly, Scott, there's nobody better than you to help share this opportunity. Very much appreciate your time tonight, Scott. Thank you.
Thank you. Take care.
Everybody have a great night. We'll look forward to seeing you guys again soon. Thanks for coming.